Welcome back to the channel, users of the tube. Today we're going to talk about how you can earn between 4 to 7% on your cash savings using the liquidity platform called Aave, and how this DeFi or decentralized finance model compares to traditional centralized savings accounts or peer-to-peer lending. So before we can get that market-beating 4 to 7% interest on our savings, we first got to understand how liquidity works. Now, when we set up a normal savings account, we're actually providing liquidity to our bank by depositing our money in our savings account. This is actually very similar to how we can provide liquidity to a DeFi platform like Aave. Let me jump onto the whiteboard and explain how this works.
Yeah, when I blow up, I'ma soar high like Peter Pan. In real life, be living out my dreams. If I'm waking up, it's in a foreign land. Whole wrist covered up in ice. Dealership, never ask the price. I hit the molly ball with my dogs. Yeah, I swipe it once without thinking twice.
So when we open a savings account, we're actually providing liquidity to the bank because we deposit our money into the bank, and in return, the bank might pay us, let's say, a measly 1% interest. The bank will then take those funds and lend them out to borrowers. So, for example, someone over here might need a mortgage to buy a house. So the bank gives them the money and charges them, let's say, 6% on a mortgage. And on top of that, they use the house as collateral. So if this person can't pay back the loan, the bank will repossess the house and sell it off and use that money to pay back the loan. The key point here is that the bank is the intermediary acting in the middle, and there's a barrier here. So the people depositing in the savings accounts don't have any exposure to the borrowers who may not pay back the loan. And that's the reason why, because it's much lower risk, the savers receive a pretty low interest and the bank gets the difference between the 1% and the 6% that they're lending it out, because the bank are the ones taking that default risk. The next model of providing liquidity, if you have spare cash, would be a peer-to-peer loan system. So in this case, your guy here is going to deposit funds he might have to lend out onto the peer-to-peer platform, let's say like Prosper or Funding Circle, and then the platform will match that lender to borrowers who want to borrow those funds. The difference here, though, is that this is just a matching algorithm and there's no barrier between the lenders and the borrowers. So if this person defaults on the loan, maybe they used to buy a car and doesn't pay it back, then the lender will lose their money, possibly all or some of the loan that they lent out. So that's why peer-to-peer lending platforms tend to pay higher interest to compensate for that risk. So in this case, you might say lend out the funds at around 10%, and the people taking out the loans might cost them, say, 12% to take out the loan. Now you'll notice there's less of a difference here between the lending rate and the borrowing rate because the app in the middle is only taking a small cut of this difference, say 2%, which is a lot less than the bank, because the peer-to-peer loan platform is taking on less risk because they're not taking responsibility for those potential defaulting loans. Now, with DeFi, the lender could convert their cash savings into, let's say, a stable coin like US dollar Tether. And let's say they've got $800 worth. They then deposit that liquidity into one of the liquidity pools on the DeFi platform. Now, the borrower, before they can borrow coins from these different pools, has to first deposit collateral. So, for example, let's say the borrower had $1,000 worth of Ethereum. They would deposit that collateral onto the protocol, and the platform would determine how much they're allowed to borrow based on that collateral. Let's say they could borrow $800. So in return for the lender providing that $800 into the pool, they might earn, say, 6% interest, and the borrower would be charged a small margin. Well, the protocol actually takes 10% of that. So the borrower might pay 6.5% interest from borrowing from that pool. Now, the advantage of this system is that the lenders get the protection of the savings bank system up here, because if this person defaults, then the Ethereum is confiscated automatically by the protocol. It's sold off and used to pay those dollars back into the pool. So the lender is protected. However, it also has the advantages of the peer-to-peer system, because these interest rates for using this liquidity pool are determined by the amount of demand and supply for those coins. So this rate can obviously change as more borrowers need more US dollar Tether or Ethereum or Bitcoin or whatever is in these different pools. So now we understand the basics, let's jump onto the platform and show in more detail how you actually set this up.
My name is Jay Barrett. I'm an investment banker, bond trader, and entrepreneur, and I'm here to help you improve your business and financial game. So starting on the Aave homepage, we can see that the current liquidity on the platform is around $7.8 billion. Coin liquidity pools are split across different markets or blockchains, like the level 1 Ethereum or level 2 networks like Avalanche or Optimism. If we launch the app and go to markets, the biggest market is actually the Ethereum network. Sorting by the annual percentage yield on that network, it will show you all the best yielding coins at the top. You can also browse across the different networks, because you may find certain coins like US dollar Tether have better returns on other networks. So for example, if we go to the Avalanche network, there is US dollar Tether top of the list. To make a realistic comparison to savings accounts, I'm focusing only on the stable coins pegged to the US dollar with no market price risk, such as US dollar Tether, USDC or DAI stablecoin. So if we click on this US dollar Tether example, it shows you here the max loan to value rate for this pool, and that's referring back to that example where it tells the lender the maximum amount they can loan depending how much collateral they put up, in this case 75%. It also shows you the historical interest rate in this pool determined by the demand and supply, in this example between 2 to 4%. And actually I found this DeFi report from CoinShares, and it pointed out that lending rates have actually come down since the start of the year from around 6 or 7% to around 3% at the moment in October. However, if you look at the top here, you can see the rate on the USDT is 2.47, but you also have to take into account this additional bonus reward on top of that to get the combined return for this particular coin. So if we want to earn this rate, we now have to connect our crypto wallet. By clicking Connect Wallet, I recommend to use Metamask, although you can see there are other choices available on the platform. However, before we connect the wallet, we first have to set up Metamask. Once you're logged into Metamask, click up here to add the network, Avalanche in this case, that you want. And make sure you're using a reliable source which gives you all the network details, such as Etherscan or one of the support pages for the blockchain you're using. In this case, an easier way to do it is using Snowtrace. And if you come down to the bottom of the page, click Add C-Chain to the network, it will do this automatically for you. So just approve this pop-up, switch network. When you go back, you should see the Avalanche network is now added to your Metamask wallet. You can see here in the drop-down, it's actually switched automatically from Ethereum to the Avalanche network, and there's the Avalanche coin in our wallet. For the next step, we now need to convert our cash savings into the crypto stable coin so that we can deposit these into Metamask. To do this, it's best to do on an exchange. I'm using FTX, and if you look here in my wallet on FTX, I actually already have a small amount of USDT down here, and if I click withdraw, I can actually do this directly from the platform. So I would enter my Metamask address, which is here, so just copy that and paste that into the address field. And then, really important, you have to make sure to select the correct network you want to transfer the USDT onto. So in this case, it's Avalanche. So I select AVAX. Then select the amount you want to withdraw. So take out all of it. And if I click continue, it would then execute that transaction and withdraw the funds from FTX into Metamask. Now, I did actually do this earlier. And if I refresh the list in Metamask, it should show up. So this is $101 worth of USDT I already transferred into my Metamask. So now we have the funds in the Metamask account. We can now connect our Metamask wallet to Aave. So come back into Aave, click Connect Wallet, select Browser Wallet, and it will do this automatically for you. Click Connect, and there you go. It's done it. So it's showing that the 101 USDT in Metamask is now showing up as available for me to supply into the liquidity pool on Aave. So now we have the Metamask wallet connected, we can go ahead and supply our US dollar tether into the pool. However, I forgot to mention, you also need to make sure that you have some of the token for that network, so in this case Avalanche tokens, in order to pay the gas fees for the transaction. You'll see what I mean in a moment. So if we click supply to supply the coins into the pool, select the amount that you want. I'm going to put the full $101 in here. Gives you a summary of the transaction, that 2.47% plus the bonus rate. And down here shows you the gas fees for the transaction. So I'm going to approve that. Just go through the pop-ups to approve access into my Metamask wallet. Now go ahead, supply. Again, it gives you this summary, shows you the gas fees in those AVAX tokens. I'm going to accept that. Once you've clicked supply in Aave, you have to go back into Metamask, into activity, and make sure that this approval has gone through. Now back to Aave, and it's all done. I would also suggest you accept the recommendation to add the Aave A token to your Metamask wallet so you can track the balance of that US dollar tether as you're earning the rewards. So I'll click add to wallet and go through the approvals and then click OK. Now we have actually gone ahead and supplied that into the pool. And if we check our Metamask wallet, go back to assets, there you can see that new token, the A US dollar tether, is now showing in our wallet, which is the amount we've supplied into the pool. So to compare these Aave liquidity pools with traditional cash savings, we've next got to think about how do the risks differ between the two options. But before I conclude the video on that, I'd really appreciate it if you'd help to support the channel by smashing that like button down below. Maybe subscribe if you get value out of this and you'd like to see more content I'm planning to make this year. And help me hit my goal of my first 1,000 subscribers. Right, now that's out of the way, let's jump back on the whiteboard and examine the risks.
So examining the risks of these different products, if we start with traditional savings, from a default risk perspective, as long as you're depositing less than £85,000 in the UK, your deposits are fully protected. So I'd say the default risk is low. Market price risk is basically not applicable because you're depositing cash, so the asset price doesn't vary. User risk is low because the bank is doing everything for you. Blockchain risk is not applicable because obviously it's not a blockchain product. Inflation risk, however, is higher because you're getting such a low interest rate. And if inflation's currently around 10 to 11%, your savings are getting eaten away. Check out the link in the description if you want to see more of a deep dive on these risks for savings accounts. So inflation risk, I would say, is high. But overall, obviously, savings accounts are bog standard and they're a low risk product. So I would rate it low risk. Looking at peer-to-peer lending, well, default risk is the biggest one here, which is definitely high risk because you have direct exposure to the peers that you're lending money to. And if they default, you could lose all your money. Market price risk, again, not applicable because you're lending out cash. User risk, I would say, is medium because the peer-to-peer platform will do most of it for you, but you do have to have some sense in choosing who you want to lend to and their different credit risk profiles. So you could make a mistake there. Blockchain risk, not applicable. It's not a blockchain product. And inflation risk, I'd actually say is low because you're getting a much higher interest rate to compensate you for that high default risk. So inflation's not going to eat into this quite so much. So if I had to rate this, overall, I would actually say that peer-to-peer lending is quite high risk because of this default means you could basically lose everything. Or if you want, maybe medium to high. Lastly, looking at the Aave DeFi platform and the liquidity pools, well, the default risk, I think, is low because Aave and these lending protocols rely on this over collateralization principle. So you have to put down that collateral and you can only lend, say, up to 70, 80%, and you get liquidated if you can't pay it back. So if you're supplying that cash savings into the pool, your default risk is very low. In terms of market price, if you're only using these stable coins, then obviously you don't have exposure to the prices going up and down, so the risk would be low, unless you do choose other coins which do have market price risk, like say Ethereum. So depending which you choose, I would say that that is a medium risk. User risk, however, is, I'd say, high here because with a DeFi platform, it's decentralized. So there's no central counterparty to help you if you do something wrong. And if you do make a mistake, you could risk losing some or possibly even all your money. So you do have to understand what you're doing. Blockchain risk, I would say, is medium. Now, this means that there have actually been cases where some protocols and platforms have been hacked, either the blockchain itself or the liquidity pools on the platform. So there is a risk there, and I'll come back to that later. But you do have to be aware that your funds are to some extent at risk of that. So I'll rank that medium. And then inflation risk, I'd also say is medium because, again, you're getting a much better interest rate than that measly savings account rate. So inflation is going to eat into your returns to a lesser extent. Now, if I had to rank this overall, particularly because the default risk is much lower, I would say overall, in my opinion, the risk of DeFi is medium. And if you think about that, low risk, low return, high risk, high return, medium risk, kind of medium level interest rates. So now we understand the risks. How can we mitigate some of these so we can have the same confidence we have in a savings account, but get these market beating returns of the DeFi liquidity pools? Well, the default risk, that's already taken care of by the over collateralization. Now, market price, as I said, if we're sticking to the stable coins, then we don't have exposure to price fluctuations, and it's more similar to a cash savings product. So, stable coins. In terms of user risk, well, there's two things you can do here. One is to just learn and educate yourself how crypto works, and also to make sure you put in place appropriate security measures on your account so that your account doesn't get hacked. Check out the link above for a deep dive into these measures you can take in my video on buying your first crypto. In terms of the blockchain protocol, this is a harder one because you have no control over the platform or the protocol being hacked. However, what you can do is diversify your exposure across different DeFi liquidity pools, putting smaller amounts in multiple pools where you spread out that risk. So if one account gets compromised, you've still got money in all the different pools. So diversify.
So in terms of looking for other liquidity or lending platforms to help diversify your portfolio, there are a couple of good tools. So one is called DeFi Pulse, which shows a leaderboard of the top DeFi players, and you can sort by number of users or total value locked on each platform. You can see there Aave number 3, so one of the top players. Another good tool is called DeFi Llama. Again, you've got a leaderboard view, and if you want to click into any of these players, then here, for example, make a DAO, tell you all about the protocol, some interesting charts and what they do. Another one worth checking out is DApp Radar. Again, got loads of stats. This one has a massive number of different platforms. And lastly, Token Terminals, also worth checking out because they have some really good charts where you can actually see over time how much liquidity is on all of these and how these guys kind of rank against each other. So I quite like that one. There is a further mechanism that Aave has to try to protect the protocol if it was hacked or there was some extreme volatility affecting the liquidity pool. And they call that their safety module, which on their website apparently is currently secured with around $340 million worth of Aave tokens. And to briefly summarize, the way this works is people can actually purchase the Aave tokens and then stake them, and then I think 6 or 7% for the staking rewards. And then the money in that pool can then be drawn on if there are any deficits on the protocol. And this obviously provides a further layer of protection. And if you want to know more about that, they have lots of documentation on the Aave site and explains all the details how that safety module works, which can give you more peace of mind against that protocol risk.
And then lastly, inflation risk. Well, here you just need to keep an eye on the interest rates and compare that to the current inflation rates to try and make sure you're not losing out, or at least not losing so badly. So look at interest rates.
So in conclusion, I have found that liquidity platforms like Aave offer far superior returns, around 4% or more on cash equivalents like stablecoins, compared to traditional bog standard savings accounts offering measly 1 or 2% interest. Assuming though that you are careful and you take those risk mitigation steps, you know, this is a great product. And I also think you gain a huge amount from actually taking the time to learn how these highly innovative, brand new financial products work, because the crypto industry is going to become mainstream soon. And if you have got a small amount of your portfolio allocated to products like this, and you actually understand how these work, the higher returns aside, you're already far ahead of the majority of the population in your financial journey to independence. So, not financial advice. Obviously, do your own research and make your own decisions. But I definitely think that DeFi platforms like this are really worth your time and worth looking at. So, if you found this useful, consider dropping me a like below to support the channel, and ask away any questions in the comments. Also, if you'd like to see more videos like this on DeFi, crypto, and general investments, then subscribe and hit the notification bell. In the meantime, that's it from me. I hope you've enjoyed it, and I'll see you in the next one. Peace.
Bossy, 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 we just bossy,